America's car market is now the biggest recession trigger no one is talking about. Beneath the glossy dealership ads and record-high vehicle prices, a silent catastrophe is unfolding. Over 3 million cars are projected to be repossessed in 2025, the largest collapse since the 2008 crisis. Inflation shattered affordability, interest rates crushed buyers, and millions were pushed into 7-year, 8-year, even 9-year loans they could never sustain. Now payments are failing nationwide. When cars disappear, jobs disappear, and when jobs disappear, the economy follows. This is how a transportation crisis becomes America's next recession. America's car market didn't collapse overnight. It was engineered, one loan extension at a time. For decades, the standard auto loan lasted 36 to 48 months, reflecting what consumers could reasonably afford. But as vehicle prices surged past $40,000 for new cars and $27,000 for used ones, lenders quietly shifted the entire system. They stretched loans to 60, 72, 84, 96, and even 108 months, not to help consumers, but to protect sales volumes in a market where affordability had evaporated. This ultra-long financing model has now become the backbone of American car buying. Nearly 1/3 of all loans exceed 72 months, with millions of households locked into contracts that outlive the vehicle's useful life. A car designed to last 10 years is now financed for almost that long, leaving buyers trapped in debt long after depreciation destroys the vehicle's value. And because interest rates climbed from 3 to 4% to 6 to 9%, the total cost of ownership quietly exploded. A $45,000 car financed over 84 months at 7% can generate more than $12,000 in interest, turning a middle-class necessity into a multi-year financial burden. The most alarming consequence is how this structure disconnects monthly payments from true affordability. Lenders reduce the monthly bill to create the illusion of stability. A buyer sees $650 per month and thinks it's manageable, never noticing that the loan's lifespan has doubled. This psychological trap, the payment over price model, allowed dealerships to continue selling cars even as living costs soared. But stretching payments doesn't stretch incomes. The debt still accumulates, the interest still compounds, and the vehicle still loses value far faster than the loan balance falls. By year 4 of an 8-year loan, many borrowers discover they owe thousands more than their car is worth, making refinancing impossible and trade-ins pointless. This is the structural fracture now destabilizing the entire auto finance ecosystem. When millions are locked into loans built for a world of rising wages, but forced to repay them in an era of inflation, stagnant incomes, and soaring insurance costs, defaults become inevitable. Ultra-long loans didn't save the car market, they delayed its implosion. And now, the very mechanism invented to hide unaffordability is triggering a cascade of missed payments across America. The rise of ultra-long auto loans didn't happen in isolation. It was the direct response to a market that spun completely out of control when inflation detonated vehicle prices across the United States. What unfolded between 2020 and 2023 was not a routine fluctuation. It was the most violent price spike in the history of the American used car market. Vehicles that once cost $18,000 to $22,000 suddenly climbed into the $28,000 to $35,000 range, with some segments jumping more than 40% in less than 2 years. A perfect storm created this explosion. Factory shutdowns slashed new car supply, while global chip shortages froze production lines and eliminated millions of vehicles that should have entered the market. At the same time, leasing, which typically returns 3 to 4 million lightly used cars to dealers each year, collapsed. Lease returns plunged as consumers held onto their vehicles longer, and the nation's inventory of modern, low-mileage used cars evaporated almost overnight. With supply gutted, demand had nowhere to go but upward. Buyers who couldn't afford new cars were forced into a market where used vehicles were now priced like luxury assets. A 3-year-old sedan that sold for $16,000 before the pandemic suddenly carried a $24,000 price tag. Pickup trucks and SUVs rose even higher, with some used models exceeding the original MSRP of their new counterparts. This inflation shock didn't just push prices higher, it fundamentally distorted the relationship between value and debt. Americans borrowed tens of billions against inflated vehicles whose true worth was already weakening underneath them. The moment production normalized and chip supplies returned, used car values began to fall back toward reality. But the loans tied to those vehicles did not fall with them. This widening gap is the core instability now feeding into rising delinquency rates. Borrowers are stuck paying loan balances anchored to the peak of the bubble, while the vehicles themselves have already lost 20 to 30% of their inflated pandemic-era value. What began as a supply chain shock quickly evolved into a nationwide affordability crisis. And as prices correct downward, the borrowers who finance those peak-price vehicles are discovering a harsh truth. Their loan balance exists in yesterday's economy, but their car is worth today's. This disconnect is now accelerating the financial strain that pushes millions closer to default. The used car price explosion created one of the most dangerous financial distortions in the consumer economy, a surge in negative equity that is now detonating across the nation. As prices retreat from their inflation-driven peak, millions of borrowers are discovering that the value of their vehicle has collapsed far faster than their loan balance. This imbalance is no small issue. It's a structural threat capable of triggering mass defaults. Today, an estimated 1 in 4 Americans trading in a vehicle carries negative equity, with the average deficit exceeding $6,000. For many recent buyers, the gap is far worse. A car purchased for $32,000 at the height of the shortage may now be worth $22,000, even as the loan balance remains locked around $28,000. That $6,000 loss is not theoretical. It is hard debt that households must swallow immediately if they attempt to refinance, trade in, or exit a loan. Negative equity becomes explosive when paired with longer loan terms and higher interest rates. With 72 to 108-month financing, borrowers barely reduce principal during the early years. Most of their payments service interest, not debt. So when vehicle values correct sharply, these borrowers find themselves sinking deeper each month, even while making every payment on time. This dynamic accelerates financial stress. When a vehicle is worth far less than the outstanding balance, owners have no exit strategy. They cannot trade in without rolling thousands of dollars into a new loan. They cannot refinance because the collateral fails to meet lender standards. And they cannot sell privately without incurring a loss that many do not have the savings to cover. The loan becomes a trap, a debt anchored to a depreciating asset with no recovery path. As used car values continue normalizing, this negative equity gap is widening. Every drop in market value increases the financial pressure on households already stretched by higher insurance premiums, rising repair costs, and stagnant wages. This is the point where stress turns into delinquency. Negative equity is not simply a mathematical inconvenience. It is the trigger that converts affordability issues into full-scale defaults. When debt exceeds value by thousands of dollars, one unexpected repair, one lost shift, or one missed paycheck can push a borrower from barely stable to underwater. This expanding deficit is now a central force accelerating repossessions across the country, setting the stage for the next wave of financial fallout. The negative equity crisis is only the surface layer. Beneath it lies an even more alarming fracture: the accelerating collapse of America's subprime auto loan sector. This portion of the market, made up of borrowers with weak credit and limited financial buffers, always shows stress before the broader economy. And today, their distress signals are unmistakable. Subprime 60-day delinquencies have surged to 6.43%, the highest level in more than a decade. That number is not simply a statistic. It represents hundreds of thousands of households missing payments on the only asset that connects them to work, school, and essential services. For borrowers already trapped in loans with 10 to 15% interest rates and extended terms, inflation has erased the remaining space in their budgets. Rising rents, soaring utilities, and escalating insurance premiums have left no margin for financial shocks. This segment is the first to fall because their loans were structured with almost no resilience. Higher interest rates front-load debt, meaning subprime borrowers spend years paying mostly interest rather than reducing principal. When prices normalized and used car values dropped, These households were hit with the harshest version of negative equity, double-digit rate loans attached to vehicles losing value faster than the loan balance could decline. As payment failures increase, lenders tighten standards. As payment failures increase, lenders tighten standards. That reduces access to refinancing or restructuring, leaving subprime borrowers with no escape route. The options shrink to two: continue making unaffordable payments or default. The growing share of borrowers choosing the latter is what's feeding the current spike in repossessions. The subprime meltdown matters for another reason. It reveals the true condition of the American consumer. While markets celebrate stock gains and corporate earnings, the financial foundation of millions of working families is deteriorating. When the most vulnerable lose their vehicles, they often lose their jobs soon after, pushing them into a cycle of missed payments across other forms of credit. This is why subprime auto distress is a leading indicator of broader economic decline. It signals that households living closest to the edge no longer have the ability to absorb rising costs or falling vehicle values. And as more subprime borrowers slide into delinquency, the pressure moves upward, eventually exposing the fragility of the entire auto finance system. The subprime collapse is not an isolated warning. It is directly fueling the largest repossession wave America has witnessed since the last major financial crisis. As inflation, negative equity, and rising interest burdens converge, the numbers have accelerated far beyond normal economic cycles. Analysts now project that 820,236 vehicles will be repossessed in the final quarter alone, a staggering volume that signals severe strain across the entire borrowing landscape. This surge is not happening slowly. It is unfolding in real time, with monthly repossession counts climbing at a pace not seen since 2008. Lenders, faced with rapidly deteriorating loan performance, are moving aggressively to recover collateral before values fall further. When used car prices began correcting from their pandemic highs, vehicles that once minimized lender losses now generate significantly lower auction proceeds. That gap leaves financial institutions with growing shortfalls, incentivizing faster repossession activity to limit further erosion. The projected 3 million repossessions for the full year highlight another deeper breakdown: the mismatch between American incomes and the cost of essential transportation. Millions of households entered loans with inflated prices, high interest rates, and extended terms. As financial pressure mounted, they prioritized housing, food, and utilities, pushing car payments further down the list. Repossession became the outcome not of irresponsibility, but of a financial hierarchy reshaped by economic stress. This wave has consequences that extend far beyond individual borrowers. Every repossessed vehicle feeds into a secondary cycle of economic damage. Auction markets become flooded with used inventory, pushing prices down at a faster rate. Falling resale values, in turn, widen negative equity gaps for remaining borrowers, increasing the likelihood of future defaults. Auto lenders, seeing collateral values weaken, tighten standards even more, restricting access to financing for millions of consumers. The repossession surge therefore becomes self-reinforcing. Rising defaults depress vehicle values. Depressed values trigger faster lender action, and that action intensifies stress on consumers already on the edge. This cycle is now powerful enough to reshape the broader auto industry, forcing dealers, manufacturers, and lenders to confront risks they have not dealt with in more than a decade. What emerges from this pattern is unmistakable. Repossessions are no longer a background trend. They are a central economic signal that the American car market is entering a crisis phase, one capable of destabilizing multiple sectors simultaneously. The repossession surge exposes a deeper structural failure that mirrors one of the most catastrophic financial events in modern history. The United States is once again confronting a scenario where the underlying collateral tied to billions of dollars in loans is losing value faster than lenders or investors can absorb. This dynamic was central to the 2008 mortgage collapse, and it is now reappearing inside America's auto finance system. Auto loans are not isolated contracts. They are bundled into asset-backed securities, sliced into tranches, and sold to institutional investors seeking steady returns. These products appear safe when vehicle values are stable. But the foundation crumbles when prices fall and delinquencies rise simultaneously. That is precisely what the current market is showing. Cars financed at inflated prices are now worth thousands less than the debt attached to them, eroding the value of the collateral that supports these securities. When collateral weakens, financial contagion begins. Investors expect predictable payments, but when repossessions increase and auction recoveries decline, those payments become unstable. A vehicle financed at $34,000 during the peak may now sell at auction for $19,000, covering barely half the outstanding balance. Lenders absorb the loss, and the securities backed by those loans begin to reflect the deterioration. This is the same pattern that sparked panic in mortgage-backed securities before the housing collapse. The auto market also faces concentration risk. A small number of large lenders control a significant share of subprime financing. When even one major financier faces rising defaults and falling collateral values, the shock ripples outward. If multiple lenders experience simultaneous strain, the system is vulnerable to liquidity shortages, tighter credit conditions, and forced write-downs. The recent failures of heavily leveraged used car finance companies are early indicators of this systemic stress. What makes the parallel to 2008 even more alarming is the speed of deterioration. The housing market collapsed gradually over years. The auto market is unraveling in months. Vehicle values corrected rapidly once supply chains normalized, catching borrowers and lenders unprepared for the sudden erosion. With millions of loans tied to yesterday's inflated prices, the collateral reality of today is brutally unforgiving. This emerging imbalance is not merely a pricing correction. It is the structural fuse that transforms rising repossessions into a broader financial threat. When loans exceed collateral by wide margins and the securities built on those loans start to weaken, the system enters a phase where small shocks can trigger large consequences. The same pattern that preceded the last major crisis. The weakening collateral structure is not just a financial market issue. It is a reflection of a deeper collapse within America's middle class. Transportation, once a manageable household expense, has transformed into a financial burden that now rivals housing and healthcare. The numbers show a brutal reality. The median new vehicle price has climbed to nearly $48,000, while the median used vehicle sits around $27,000. These figures collide directly with wages that have grown far slower than inflation, creating an affordability fracture with no immediate repair. Insurance costs add another layer of strain. Premiums have surged more than 20 to 30% in many states, driven by rising repair costs, higher parts prices, and increased vehicle complexity. A policy that once cost $1,200 per year now routinely exceeds $1,800 to $2,200, adding hundreds of dollars to annual transportation expenses. At the same time, maintenance and repair costs have risen sharply due to shortages in skilled labor and the higher price of components. The financial load placed on households continues to intensify even before a single loan payment is made. The result is a transportation system priced far beyond what the average American worker can sustain. A family earning $60,000 to $70,000 per year faces car payments consuming 15 to 20% of their take-home income, far above the traditionally recommended threshold. When insurance, fuel, and maintenance are added, total transportation costs can exceed $10,000 per year, making it one of the largest expenses in the household budget. This breakdown is why defaults are accelerating across all borrower groups, not only among the subprime segment. The middle class now faces the same pressures that historically impacted only the most vulnerable: income falling behind expenses, declining purchasing power, and rising debt burdens. Many households remain current on payments only by cutting back on healthcare, groceries, or savings. That level of sacrifice cannot continue indefinitely. As affordability collapses, the car market transitions from a strain into a destabilizer. The middle class is no longer absorbing economic pressure. It is transmitting it back into the financial system through missed payments, reduced spending, and shrinking demand. This turning point is crucial. When the economic engine that once sustained the auto industry can no longer afford the basic cost of mobility, the pressure shifts upward. forcing lenders, manufacturers, and investors to confront risks that were once unimaginable. The middle-class affordability collapse is not an isolated hardship. It is the ignition point for a broader economic chain reaction. When millions can no longer sustain the cost of transportation, the effects flow far beyond individual households. The auto industry, a sector responsible for more than 4 million American jobs and hundreds of billions in annual economic output, becomes the next point of failure. And the shock begins where the pressure is most visible: repossessions. When vehicles are repossessed at scale, mobility disappears. A worker who loses their car in a country where 86% of Americans commute by vehicle instantly faces compromised employment. Missed shifts, job losses, and reduced income follow, pushing financial stress into other sectors: credit cards, personal loans, mortgages, and retail spending. The borrower who loses a car rarely stops at one delinquency. The disruption spreads into every corner of their financial life. For the auto industry, the impact is equally severe. Repossessions flood auction markets with inventory, driving resale prices downward. Lower auction values mean lenders recover a smaller portion of defaulted loans, forcing them to tighten underwriting standards. That tightening makes it harder for millions of potential buyers to qualify for financing, reducing dealership sales. Slower sales push manufacturers to cut production, which cascades into layoffs, reduced supplier orders, and declining factory output. This contraction travels quickly through the supply chain. Auto parts suppliers, transport companies, semiconductor manufacturers, and service departments all experience declining demand when vehicle sales fall. A slowdown in one of the nation's largest industrial sectors creates immediate pressure on GDP, state tax revenues, and local economies dependent on manufacturing payrolls. At the financial level, rising delinquencies weakened the performance of auto loan-backed securities. Institutional investors respond by demanding higher yields or reducing exposure altogether. That forces lenders to raise rates or limit lending further, which suppresses consumer demand even more. It becomes a reinforcing loop: fewer buyers, fewer loans, fewer sales, more layoffs, more defaults. This is how a repossession crisis transforms into an economic threat. It compresses mobility, chokes credit access, dismantles consumer spending, and destabilizes one of America's most important industries. The conditions required for a recession are simple: widespread consumer stress, contracting credit markets, and weakening industrial output. The auto debt collapse is accelerating all three simultaneously, pushing the country closer to the point where economic pressure turns into an undeniable downturn. The economic chain reaction triggered by mass repossessions exposes a deeper fragility within America's financial system. As defaults climb and auction recoveries fall, lenders face mounting losses that spill directly into credit markets. The performance of auto loan-backed securities, a market worth hundreds of billions of dollars, begins to deteriorate. Investors respond with higher risk premiums, forcing lenders to tighten standards and raise rates. The result is an immediate reduction in credit availability, shutting millions of households out of the auto market entirely. A slowdown in credit is not just a banking issue. It destabilizes the broader economy by restricting the flow of consumer spending. This tightening occurs at the same moment the middle class is already under historic financial pressure. With transportation costs consuming thousands more per year and real wages failing to keep pace, households lose the flexibility needed to absorb economic shocks. Any disruption, a lost job, a medical bill, a shift in hours, becomes enough to trigger cascading delinquencies. As more families fall behind, the strain radiates outward into retail, housing, and labor markets. This is the point where a sector-specific crisis transforms into a macroeconomic threat. When millions lose their vehicles, mobility declines. When mobility declines, workforce participation drops. And when workforce participation drops, consumer spending, the engine of 70% of US GDP, contracts. America is approaching a threshold where the auto debt collapse is no longer a warning sign, but a defining risk. The combination of rising defaults, shrinking credit access, falling collateral values, and weakened consumer resilience forms the precise environment that has historically preceded major downturns. The question is no longer whether the car market is in crisis. It is whether this crisis becomes the spark that pushes the entire economy into recession. A recession triggered not by Wall Street, but by the collapse of everyday Americans' ability to afford the basic cost of transportation.